Hi, it's Mike McCarthy, the Insurance Advisor. In this video, I'm going to be talking about income protection, which is your most valuable asset. Not your house, not your car, your boat, or your jewellery for that matter. Your most important asset is your ability to earn an income and to work. So what is income protection and how does it actually work? Well, in short, if your GP says you can't work because of an illness or injury, then the insurer pays you a percentage of your income after a wait period. The insurer pays you until you can either return to work or for a set period called a benefit period. Now, this all depends on you submitting a claim to the insurer that is accepted, of course. And that is why you need to talk to an insurance advisor to help you with submitting a claim. Income protection does not include redundancy cover. However, this can be bought as an additional benefit to an existing income or mortgage protection policy. Understand also that in this video I am largely talking about policies that are owned personally by individuals. So if you're self-employed, a business owner, then you're likely to have other options that we can chat about. Today, I will be covering off the three most common types of income protection policies, which all insurers offer: indemnity insurance, agreed value insurance, and mortgage protection. Loss of earnings is one that is commonly offered. However, it's a lot more complex depending on what insurer you're with. So I'll cover this off in a separate video. So, indemnity insurance, indemnity cover. This is where you insure your income for an amount, however, you must prove your income at claim time. So, if your income has dropped, then the insurer may pay you out less than what you're actually insured for. Indemnity cover is taxable, so it's likely that after you've received some money from the insurer, then you're probably going to have to give some back to the Inland Revenue. The cost of indemnity, however, can be claimed as a tax deduction. However, you're best to cover that off with your accountant. Also, one thing to note about indemnity insurance is that if you have an accident and ACC are paying you income compensation, then ACC payments will take precedence. This means that you will not get both ACC and indemnity insurance. The indemnity insurance will be offset by ACC, so it won't pay, while ACC is paying more than what you're insured for. Okay, agreed value insurance. This type of insurance protection is designed to give customers certainty. You prove your income at application time, usually with 2 or 3 pay slips. Then the amount insured is an agreed value for the term of the income protection contract. Any claim is not taxable, therefore it's not designed to be claimed as a tax deduction. Also, like indemnity insurance, it will not pay out while ACC income compensation pays. Mortgage protection. So you may ask, why have I included mortgage protection in an income protection video? Well, that's because mortgage and income protection are very similar in the way that they are structured and how they pay at claim time. However, the big difference with mortgage protection is that in most cases it's not offset by ACC compensation. And I'll talk a little bit more about that in the next few slides. So, usually you will need to prove your mortgage repayments at claim time. You need to also show that the mortgage repayments are for a home that you live in. You'll need to prove that you're responsible for paying that mortgage. So if your home is owned by a trust, then chances are you're going to have to rustle up your trust deed for the insurer. Now at claim time, most insurers will not ask you to prove that you still have a mortgage. However, there are policies that can make it a little bit more awkward for you to get your money if you've paid off your mortgage. So if you've paid off your mortgage, then it's a good time to talk to your advisor and review your policy. The other thing to mention is that mortgage protection payments to you are not taxable. Okay, let's talk structure. There are two key elements to the structure of your cover. One, the wait and the benefit period. Secondly, the monthly benefit amount that you want to be insured for. So first up, let's talk about the wait and benefit periods. Wait period. So you will need to elect how long you are prepared to wait to get paid. The most popular options are 30 days, 60 days, or 90 days. The benefit period is the maximum term that you would like the insurer to pay you if you are permanently knocked out of work from an illness or an injury. The most popular options with insurers are for 2 years, for 5 years, or to age 65 or to age 70. Understand that choosing a wait and benefit period are decisions that you need to make when talking to your insurance advisor, as these decisions also have a direct effect on the cost of your insurance. Firstly, understand this. The more risk the insurer carries, the more cost it is to you. The more risk that you are prepared to carry, then the less it costs you. Let me show you what I mean. So, if you look at these graphs, you will see that this option shows a wait period of 30 days and a benefit period of to age 70. Understand this, that let's just say you're 40 years old and you're permanently knocked out of work, then the insurer is literally in the gun to pay you a monthly payment for 30 years, opposed to having a 2-year claim period, which reduces the risk for the insurer and therefore reduces the cost to you. The job of an insurance advisor is to help you understand the risk of choosing a shorter benefit period and the implications of that should you be knocked out of work for longer than that period that you choose. Wait periods. So you can choose how long you want to wait to get paid. Once again, the longer you wait, the more risk you carry, hence the cost will reduce. So, do you already have this type of insurance? And are you seeing the cost increase? Just understand that you can always increase your wait period or reduce your benefit period to help you manage those costs at any time. Understand that if the cost gets too expensive, you do have options to manage it, even if it means reducing the amount that you are insured for. Anyway, these are conversations that you have with me or your insurance advisor, like me. Let's look at your insurable income and how it's worked out. Here's an example of someone who's paying an annual salary of $100,000. The maximum income that this person can be insured for is $75,000 per annum gross. And this is using indemnity insurance, which is also taxable. Or for a little less, you can get agreed value cover, which is not taxable. Note, the insurable income percentages do change as your income increases, but this gives you a sense of how insurers calculate your insurable income. You'll also see that I've added in ACC compensation because, well, I'm an insurance advisor, and ACC is a type of compulsory insurance that all income earners are levied for. So I would not be doing my job if I did not add this type of cover in the mix. Plus, it's super important to understand how your income protection policy performs if you have an accident and ACC are paying you compensation. You will see that I have included mortgage protection for $3,000 a month, $36,000 per annum in this particular graph here. Bar graph, should I say. I have included another option also where you can split your income protection and have it classified a little differently. Here you can see that I've classified 40% of this person's income a little differently and topped it up with income protection to the agreed value level. Understand this, that in either of these scenarios, if you can't work because of illness, then all of these values should be applied to a successful claim. However, if you had an accident and ACC compensation was paying you after your wait period, then look at what happens. Yep, all the income protection options are 100% offset by ACC, meaning that while ACC is paying you more than your income protection benefit, your income protection benefit is not paying. Whereas the blue options pay out net on top of ACC, which puts you in a way better financial position. And more importantly, it allows you to recover better. Speaking of ACC, here's a little tip. So when you're doing an income or mortgage protection application, what you need to do is you need to declare all your past illnesses or injuries or when you last went to the doctor, etc. Now, let's say you could not work because of back pain and you had a claim. The insurer will check your ACC records, and if you've had back issues in the past or the near past and you did not declare these, then the insurer could decline your claim. So when you're doing an application, talk to your advisor and ask them to help you get access to your recent ACC injuries. It's quite easy. Here's mine to show you what it looks like. The reason why you should do this is because, well, I don't know about you, but it's easy to forget that you may have seen a physio 2 or 3 years ago, you know? So if you declare it and you do get an exclusion for a pre-existing condition, at least you know what you're not insured for up front. Anyway, I hope you got some good information from this. I hope that if one thing that you take away from this video is how important it is to get good advice and to get the right insurance product for you. Because when you're buying insurance, you need to understand that you're actually buying a claims experience. And at claim time, you need to be absolutely confident that your advisor and the policy will perform the best for you. There we go. So that's about it from me. Now, I've got a Calendly link in the details of this video where you can book an appointment or a 15-minute chat with me really easily. Or if you like, you can just go to my website, theinsuranceadvisor.co.nz, and hit the Inquire Now button and let's catch up. Anyway, if you like this type of content, feel free to like and subscribe for more insurance insights. Bye for now.